Good morning, ladies and gentlemen. A warm welcome to this session entitled Are Hotels Still Good Value? Which is being hosted in a partnership between Alix Partners, HVS, Bird & Bird and EP. So we're delighted to welcome you this morning. We have a great panel, which we're also delighted to welcome to answer all kinds of key questions that I'm sure is on most people's minds today. The leading question of this webinar, obviously, are hotels still value, has been an underlying theme ever since the start of lockdown. Many are looking to estimate the potential impacts on assets and asking a whole range of key questions, such as how long will the recovery process take, which seems to get harder to predict all the time. In our recent webinars over the last few months, the answer seems to lie anywhere between late 2022 and 2023. Is that what you still believe? Question mark. There are obviously rising concerns about a second spike and a further lockdown across Europe. What would this mean and what would be the impacts? And when will average rates return to pre-COVID levels? A contraction in value is natural, but is it short-term, or are we likely to see take a long time to rebuild? Our last webinar, we analysed the external factors, including the availability of financing, the pool of potential buyers, the alternative investment solutions, and these all need to be taken into consideration when actually examining value. One of the real problems that we face today is trying to find genuine clarity on how the pandemic is going to play out over the next 3 months, let alone the next year. There are so many uncertainties hanging in the air. And back in June, most of us expected that September would be out and seeing a clear path to recovery. But as we know, that is obviously a bit more complex than we expected back then. There are a whole range of barriers that seem to be in place. And there are fundamental changes taking place in structure and in work patterns. It is clear that roadmap for city centres is going to be far more challenging than many probably expected back at the start. It seems clear that most working patterns will be back to 2 to 3 days work in the office. So how will this impact on many hotels? Air travel is not expected to return to strength until about 2024, 2025. How does this impact on hotels and valuations? And the same about corporates. When will corporates be returning to the marketplace in strength? And that impacts on all kinds of different levels. If there is a second spike and further lockdown, what will this mean for us? Will the UK government be persuaded to extend furlough in order to reduce the threat of even more redundancies taking place, which is obviously a major concern to many companies. So much to answer, much to think about. There is a reported move towards localism, a rise of localism, which may favour resorts and rural destinations, which actually will again have its own impacts. Is this something which is again just a short-term piece, or does it have long-term ramifications as well? Will resorts return to strength faster than city centre hotels? And finally, what new services can be developed, and how can actually space be reimagined for use as well? Well, how will the hotel sector change? These are all questions that are being debated every day across the industry. For today, there are a number of leading questions to be answered, which include: what are your view on valuations as we stand? How will investment strategies be changed from pre-COVID-19? How would landlords think and act given the concerns and the threats? And which markets will recover first? And how long would that recovery process take? So important questions to answer. So over the next 1.5 hours, much to debate. May I firstly just give a warm welcome to our partners and the hosts for today, who include Graham Smith, Managing Director of Alix Partners, Russell Kett, the Chairman of the London office of HVS, and Karen Freeb and James Salford, Partners of Bird & Bird. Thank you for their involvement and cooperation and support on these events. Thank you. Now we have some polling questions to pose to you to see what your views are as we start the session. So let me pass over to Lauren to pose those questions. Thank you.
Thank you, Chris. Good morning, everybody. Thank you so much for joining us. Yes, polling questions I'd love to start off with is to just get a bit of a general view about who you are. So I've just launched that. If I could ask you to indicate what part of the hospitality sector you are most closely involved with. And the options are finance at either a unit level or central office, operations, development, marketing, sales, other sort of central office functions, ownership, investor, private equity, bank or other lender, advisory, consultancy, legal, accountancy, architecture and design, or whether you're from an educational or sort of student background. So it looks like we have a lot of advisory and consultancy and legal. So thank you very much for joining us there. Next question. Please, could you indicate your role within your organization? Are you a chairman, partner, owner, director, or part of the C-suite? A hotel general manager or a senior manager? Department head, supervisor, an operative, or other? A lot of chairman, partners, owners in the room. Thank you very much for joining us. Third quick question. Looking at RevPAR, when do you think that hotels' RevPAR levels in your location are likely to be back to the 2019 levels? As Chris said, we've been exploring a lot around this topic and others, and options are 2021, 2022, 2023, 2024, 2025, or unfortunately later. It seems that 2023 is definitely the preference. It still seems like a very long time away.
Thank you, that's really interesting. Thank you. Firstly, let me give a warm welcome introduction to my friend Russell Kett, Chairman of HVS, to host the first part of the seminar. Russell, over to you.
Good morning, Chris. Good morning, Lauren. Good morning, everybody. And thank you all for joining us. According to the little counter on my computer, we have about 315 people with us already. Thanks for answering those questions. It's my pleasure to present to you something by way of an introduction to the topic, a short presentation which I will try and make as interesting and as relevant as possible to all of you. I'm hoping that by sharing my screen, you will, interesting, my screen's just gone horrible. Let me find out what's going wrong. I just ask for your brief indulgence. There we go. You'll see the start of a presentation and the agenda that I'm going to cover this morning over the next 20 minutes looks at an unprecedented downturn. I apologize for using words like unprecedented and unique and stuff like that, but unfortunately this is the case. We've not experienced quite like this before. But as you'll see, I hope, there are some parallels with what's gone on previously. But I'm going to spend most of my time looking ahead and then concentrate on hotel values and bring everything to a conclusion in time for the panel to discuss the issues in more depth. And from where I'm standing, everything is quite unprecedented in the sense of never having experienced a downturn like it, but have we? Yes, we've experienced certain aspects of the downturn before, and I hope, as you'll see as I go along, there are some parallels which we can draw from. But anybody who's been looking at occupancy and room rate and RevPAR in depth in the last few weeks and months will be familiar with charts like this. Our friends at STR show quite clearly that as we started 2020, in January and February, everything was going along beautifully. And then we fell off a cliff. And as you can see, these hotels in Europe that were actually open dived in terms of occupancy. Their average room rate dropped, not perhaps by as much as people were fearing, but overall RevPAR declined by nearly 90% in March, still around 88% in May, 82% in June, but in July, it's starting to come back. So you can see the evidence there that the hotels that were open are starting to claw business and claw business back, not anywhere near where everything was in 2019, but good signs and a good indication across many locations in Europe as hotels have reopened and so forth. So why do I refer to the past? I think it's very important that we look at previous shocks. The most recent in this century have been post 9/11 and post global financial crisis. And it's quite interesting just to recognize that in both of those cases, you had approximately 6 years peak to peak. So the recovery of supply, demand, occupancy, and so forth, all coming together, was around a cycle of 6 years, both for 9/11 and the global financial crisis. And as I look forward beyond there, post 9/11, post global financial crisis, and look at the terrorist attacks of 2016, you can see that there wasn't as much of an impact across European RevPAR as those two earlier crises showed. So those cycles of 6 years, I think, give us a good reason to be hopeful that this time around we can work the recovery within it. And certainly the views of the vast majority of you just now was that it will be 2023 before RevPAR is back. So let's look ahead. Winners and losers at the moment, the more vulnerable hotels perhaps, are those that are full service hotels, those that are heavily dependent on group business and MICE, luxury hotels, particularly those in gateway markets, the ones that require people to fly to internationally, particularly airport hotels and so forth. Whereas on the other side, you've got hotels that are accessible by car, the drive-to markets, extended stay hotels, serviced apartments, those that have got self-contained units, those that are in the economy and mid-scale sector. So secondary and tertiary markets at the moment holding up better and are not trading by as much a discount to 2019 levels as those that are in gateway and primary markets. They're taking their time, and you'll be familiar that several hotels in London still haven't reopened because their business is reliant on people having to fly in, which they're not doing or not able to do at the moment. You talked about a recovery in 2023. From an HVS perspective, we're looking across an average of Europe at occupancy levels coming back by 2023, but average room rates taking a slightly longer time. So rate and RevPAR coming back in 24. So you can see from this chart that we had an occupancy of 72% pre-COVID, showing a pretty deep dive for 2020 before things start to recover in 21, again in 22, but by 2023, we think occupancy should be back to where it was pre-COVID at 72%. Don't get too worried about the fact that your hotel might not be quite the same average room rate as the average across Europe that we're showing here. But as you can see, the levels of average rate in 2019, we don't feel will be back until around 2024. So the same goes for RevPAR. So 3.5 years for occupancy, 4.5 years for average rate and RevPAR. And that's well in line with what we experienced previously. As you can see from this chart, post 9/11, it took 3 years for occupancy to come back. Post global financial crisis took 4 years. We're saying 3.5 years for occupancy to 2023. Slightly longer in terms of average room rate from the global financial crisis and for this. So overall RevPAR, we're saying we'll be back within 4.5 years in 2024. What we do expect at the same time is that the supply pipeline is going to shrink in a number of ways. Clearly, anything that's well under construction and close to opening, that's going to open. It's funded. The supply pipeline of some of the materials might be a little bit constrained, so the opening date might be pushed back a little bit, but all being well, those hotels are going to be open. In terms of some projects that are further back in the pipeline, the openings might be delayed. Some developers might put them on hold, possibly indefinitely, but certainly there is going to be delay. And that delay is going to come particularly where there are financing challenges. And anything which hasn't got finance, development finance, is clearly going to find it more difficult. So that pipeline is going to be affected. And some projects are just going to get abandoned altogether, postponed, cancelled, call it what you like. And regrettably, some of the properties that have closed are not going to reopen. And we've started to see that. Even only yesterday, the announcement of the Ace Hotel in London not reopening. There are all sorts of reasons why hotels are not going to be able to reopen. Generally, it's going to be because they haven't got the money either to fund their ongoing operations or to pay for whatever measures need to be provided to reassure guests that they are hygienically safe, clean, COVID-free, socially distanced, and all that. So the supply pipeline on balance, we think, is going to shrink. What's going on is that every hotel is going through the same sort of analysis. How much can we cut operating costs? How can we minimize expense levels? How can we reduce our staffing costs in particular? We're used to operating on a shoestring. Can that shoestring continue? Can we continue to operate with fewer staff than we had before? And that payroll saving is going to help pay for things like the new cleanliness and safety protocols, rejigging our food and beverage facilities in order to be more COVID compliant is going to result in things being different. But do we have to do it with the same levels of staffing? And I think the brands in particular are going to have to look at their staffing complements and what their brand standards are or were, and work with owners to really revise what their brand standards should be going forward. Because it's very important that hotels continue to have the enhanced operating leverage as demand and revenues recover. We're used to the fact that there's a 1% growth in revenue producing a 2% growth in profitability. And that works both ways, a 1% drop in revenue, a 2% drop in profitability. So that operating leverage is very important, and hotels realize that they need to focus on that to continue to make the hotel sector more attractive. And owners and operators are already reporting lower break-even occupancy levels than before. And we're encouraged by the fact that everything is being re-examined so that the operating cost ratios can be as low as they possibly can be. Let's come to the focus of our topic today and talk a little about hotel values. As we looked on the cusp of 2020, looking backwards over the past 12 or 13 years, you could see the effect of the global financial crisis, that nice ski slope between 2007 and 9, showing the value per key dropping like a stone, as you can see there. And then the grey mass growing nicely year by year by year, a slight dip in 2016, but not very much, to reach a peak again in 2019. And as you can see with the red line, not quite as nice a straight line as the gray line is, but that red ski slope again, cap rates coming down steadily throughout that last decade as values continued to grow. And as we looked into 2020, clearly values have gone down. And there are three reasons, essentially. One is clearly there's a loss of income. When your revenue declines, and as I said, that 2-to-1 relationship in profitability, you get a more significant decrease in EBITDA. And in some cases, that will have turned negative. The debt market has pulled back from where it was. And I'm sure Bettina of Ariel will confirm that later. But loan-to-value ratios, higher spreads are all going to result in effectively higher interest rates. And despite the cuts and the overall low interest rate environment. And you've got the bid-ask gap between buyers and sellers that is meaning that transactions are not really taking place. But we expect that to narrow in the future. But on the basis of all of that, values have declined. And you've got some factors that help to push value down. And I'll get onto those that help to push value up in a moment. But pushing values down, you've got declines in revenue and EBITDA. When you're valuing, as we think you should be, using discounted cash flow, clearly you're starting with a few months and a few years possibly of reduced cash flow. The economic recession that seems to be hard on the heels of the COVID pandemic is causing people to be concerned, and naturally so. The fact that MICE business in particular is going to take a lot longer to recover, and that people's travel patterns are still uncertain. And the fact that we may encounter reinfection, more lockdowns, second, third waves, call it what you like. And the fact that every hotelier is really focused on making sure that their cash flow is as carefully managed as is possible, there could well be a cash drain that's going to force some owners to have to sell. So those are the downward pressures. But there are some pressures that help to keep values looking upwards. The fact that people are looking carefully at their operating model, reducing their staffing costs in particular, but also other operating costs have been under scrutiny, and that helps to improve margins. And the return of that positive operating leverage is something which helps to give the hotel industry a real boost. You've got that wall of money that you saw on my earlier slide, yield hungry funds lining up the capital. They do want to invest. That should create some competition and help to sustain values. The low cost of capital, I think, is likely to continue. And I think some owners and lenders are going to wait for values to rise before they recognize their losses if they can. So some positive effects, some downward effects. What's the impact on value? So to look at values across hotels in Europe, we've developed a baseline, and we took the position as at the end of 2019 and said, well, what might have happened if COVID hadn't arisen? So what would EBITDA have looked like given where we were in 2019, and where do we expect EBITDA to have gone? And that, if you like, provides a baseline from where we can then look at value. And we've chosen three different scenarios. The first, looking positive, the best case. So there's been a moderate decline in EBITDA, and that is built back and redeveloped over the next few years. We think the most likely case looks something like that, where there's a more significant EBITDA impact in the first year, and the degree and decline diminishes over time as the market recovers. And clearly, from a worst case situation, we've got a negative EBITDA in 2020, followed by a reducing negative impact as the market recovers, but a longer recovery period. So you throw all that together, and here's what the HVS values for each scenario on average across Europe look like. It's our version of the Nike swoosh, if you like. You can see that dotted line represents the baseline. And then as you get progressively more depressed, starting with the best case, the gray line, the most likely case, the blue line, and the worst case, the red line, which doesn't come back to quite the same levels as they would have been by 2025, as shown by the best and most likely case. So what we're saying is, the best case, we think the value decline is going to be somewhere between 5 and 10% in 2020. And the most likely case, somewhere between 10 and 20% decline. Worst case, 20 to 30% decline. Yes, we have encountered one hotel that we valued in the last few weeks where their drop in value has been more than 30%. It was actually about 34, 35%, but there were extenuating circumstances and a particularly short lease. So that's our conclusion as to where we think values are going to be as of now. And just to put that into context, our hotel valuation index showed a decline of 23% in value in the global financial crisis. So clearly that's within the worst case of what we're doing there. But we think because of the hotel sector having some unique qualities, which I'm sure the panel will explore, we think the most likely drop is somewhere between 10 and 20% this year. So wrapping things up, RevPAR levels we think are obviously depressed until travel and restrictions lift and people feel comfortable about traveling again, staying in hotels. And we obviously think that a vaccine will help, and that will move things a bit faster than we're showing. We're showing occupancy recovering faster than average room rate. We feel that supply growth is going to slow down a bit. That will help. And as you know, some hotels not only suspended, but have stayed suspended in the interim to help minimize EBITDA losses. And clearly with those that have remained closed, there's no point in reopening if you're only going to lose more money than it's costing you to stay closed. So we're saying hotel values have declined and will remain depressed until EBITDAs have hit the bottom, and there's some evidence of recovery. It causes hotel discount rates to be elevated in the near term, but we think those will get back to normal over the course of the next 4 years. I think the weight of capital might limit some of the discounting for hotel assets, and some of the most specialist hotel investors haven't changed their investment strategy, but they're all waiting, as they say, it's like catching a falling knife. Where do you drop? Where do you allow the price to get to before you hit in and put in an offer? And clearly that's going to happen more in the latter part of this year. And we do think over the longer term, values are going to recover. Once cash flows improve, capital markets return to more traditional parameters. And overall, we think that there is a continuing opportunity for high returns. And those buyers that are out there, they're well capitalized, they're going to acquire hotels at prices that are below replacement cost and below recent norms. And with that, I'm going to say thank you. And if I may, hand you over to Graham Smith. Graham is the Managing Director of Alix Partners. And Graham, please introduce your panel.
Great, thanks very much, Russell. That was really good just to see that and see the data and the views of HVS and how that compares to previous downturns. So as Russell says, Graham Smith, Managing Director at Alix Partners. I specialise in corporate finance and restructuring advice, and have worked on a broad range of restructuring and transaction situations in the hotel sector. Now, we all appreciate that the hotel industry is cyclical. You never know what will cause the next downturn in the cycle. But I don't think an actual global pandemic was on everyone's lips heading into Q4 in 2019, where, as Russell has showed, hotel valuations were pressing higher and higher. Now, there's a wide acceptance that the crisis will create investment opportunities, but when this will be, and also how on earth do you appraise an investment when the market is so volatile? It's some of the topics that we'll be focusing on today in the panel. We've got representation from brokers, lawyers, investors, lenders, and asset managers. So a great mix of views and experience. And we're also going to dive into the situation in the leased hotel market that has really been in the teeth of this crisis. We'll be keeping an eye on the Q&A function. So if you do have any questions, please do submit them, and we'll try and cover them in the panel session. So just to introduce the panel, we have Charles Human from HVS. Charles heads up the European offices of HVS and HVS Ward Elliott brokerage business. He's advised on a very large range of hotel deals internationally, both including groups and single assets. We have Karen Freeb from Bird & Bird. She's a partner in the London real estate team at Bird & Bird, international law firm. And Karen heads up the international hotel and leisure team, and as well as traditional real estate work, whether that be M&A, purchases, lettings and developments. Karen specialises in negotiating hotel management agreements. And during lockdown, she's been very busy giving strategic advice to clients on the terms of their leases and management agreements. And pleased to say also negotiating some new management agreement deals. So great to get her views on this panel. We have Safi Zakaria from Crosstree. Safi's been at Crosstree since 2013, a principal in the investment team. Worked on a number of high-profile transactions in the sector, including acquisition of Camden Town Hall Annex, now the Standard Hotel, and the Barra development in Shoreditch. We have Lionel Benjamin from Ago Hotels. Lionel's very experienced hotelier and hotel investor, being part of Ability Group in Topland in the past. Really interestingly, at the moment, he's just launched Ago Hotels with a hybrid lease structure in partnership with Accor, and that's obviously been linked with a number of deals with travel lodge landlords. So great to get his views on the lease market. We have Neil Kirk from London Regional, L&R. He's Chief Operating Officer there, responsible for asset management and also a key member of the hotel transactions team. Previously he was at Westmont and Henderson Park. I guess what I would say about Neil and Lionel is that Topland, Westmont, L&R were very early reinvestors in the UK hotel market after the last downturn. So their views on the recovery cycle will be really interesting. And finally, we have Bettina Graf from Ariel Bank. She's managing director there, leading its lending activities for international hotel assets, also covers student housing, and other real estate categories in Scandinavia and Turkey. Ariel's been very committed to the sector for a number of years, and in fact in 2011 was the hotel financier of the year. Lending in 2011 was not easy, as Russell's data has shown. So again, Bettina's views on the recovery will be really interesting, given the current situation. So first question is, one of the challenges that's really on top of people's mind is, how do you go about valuing a hotel in the current climate when future trading performance is so uncertain? I'd like to go to Neil first of all on that question, if I can, and get your views, Neil.
Yeah, look, I suppose when we look at it not dissimilar to how Russell was showing in his presentation, in that we will always be looking as to where we think the stabilized or recovery point is. What happens in between is difficult to forecast with all the uncertainties we know about, especially within this crisis, which is the external impact of the global pandemic. So we're looking at hotels that we believe will recover, when they'll recover, and then really it's about discounting the cash flow in that period to recovery. But it doesn't necessarily change how we've always gone back valuing. You refer to the last downturn. It's a view on what stabilization looks like, how you get there, and then discounting the period to get there, which impacts either your cash flow or the amount of risk you need to attribute to your returns in the uncertainty leading to that period. So really, we've continued to invest, in my previous role and in LNR throughout cycles. And it's always just been a view as to how long is this current cycle is going to take, the assets to reach stabilization, and the impact of the risk in between that period, either on a cash flow perspective or on the actual yields you expect to get on that period. But the model doesn't change. It's just trying to understand what the inputs are now.
Thanks, Neil. And Safi, I know from our conversations that you have been doing new deals during lockdown, and also at Crosstree, you can invest across the capital stack. How are you, appraising these situations where you've got your operators and management teams probably giving you scenarios with wide variances between best and worst case?
Well, I suppose on deals where we sit in the equity, we're appraising it much like Neil is talking about, and we're doing cash flows and from our own insight, knowing what our burn rate has been on our existing hotels. In a funny way, there's a degree of more certainty to appraising what a hotel looks like versus, say, some other asset classes, because we see hotels as being an asset class that will recover to the previous level seen, whereas, say, take offices, there may be a completely different shift in how offices are being used. So as long as you have enough buffer built in to allow for your cash burn over the short term and enough time to stabilize back to previous levels, hotels are a slightly easier beast. As you mentioned, we invest across the capital stack, and we actually did do a hotel deal during lockdown where we're in the mezzanine. It's a hotel that she was developing on Marylebone Lane. And the way you can get comfortable with that, well, it's a development, so we're hoping that we'll be out of the clouds, so to speak, by the time that the hotel is open. But also we're in a protected position versus the equity in truth. So there's still a lot of opportunities out there, and certainly we would be looking probably more if we were buying a new hotel today at ones that were under construction, simply because you don't have to allow for several £100,000s of burn during your first 2 or 3 years, which could be a drag on your IRR. Yeah, I think that's about it.
Great, thanks, Safi. And Charles, I know you're out in the market at the moment with a portfolio, and as part of that, I'm sure you are having to give your clients a great deal of reassurance about what pricing you would achieve in the market. How are you coming to that view at the moment, given the current uncertainties?
Yeah, so we're valuing essentially for 2 purposes at the moment. First is valuation reports for banks and owners who want to get a grasp of current value, and we're certainly busy on that side. And then on the other side, on the brokerage side, we're giving opinions of value for owners that may want to contemplate a sale. And we've got a number of properties in the market, as you say, both a portfolio and some single assets. And I think what we're seeing there is very interesting. We know that there's a wall of money, and that's for real. And these are buyers who believe in the recovery, and I think, as Neil said, are looking through to a point of stabilization and then trying to figure out the ramp up to that point. We're getting extremely good traction to the point of competitive tension on the sales that we're handling. And I wouldn't describe these as distressed sales. These are owners that need to sell for various reasons. These are primarily leisure-based assets, which we're seeing stronger demand for at the moment from investors, because that the recovery there is certain, if you like, because we all want to still take holidays. And I think we're seeing, in terms of pricing, we're seeing value reductions from pre-COVID levels of between around about 10% and 25%. I'd say we're seeing, depending on types of assets, operating structures and locations, but it's in that area. There's but it's clear this is a very different downturn previous downturns, in that we're starting it, if you like, with more dry powder out there than I think anyone has seen before. And I do believe that most of those investors believe that once we reach a corner, we will turn that corner, and the recovery will be relatively fast.
And that's a good point you raised there, Charles, just on that weight of capital, because you can look at the market and say that it is demonstrably more risky than it was at the end of 2019. Nobody would have foreseen that operations could have been forcibly closed by governments nationally. So the fact that it has happened means that it can happen again in the future. But offset against that, you mentioned the huge weight of capital that's available in the market, it's all looking for a home, and if other parts of the real estate market become even less palatable, so that there's more cycling towards hotels, does that offset that position? Safi, I know you manage across multiple real estate classes. Do you see that playing out in the market in terms of weight of capital offsetting what is a increased risk on cash flows to keep values more robust?
Yeah, I think that is fair. I mean, 10 years of quantitative easing and historically low interest rates does mean there is just more cash in the market now than we have had in any other crisis. And across other asset classes, the risk is maybe shifting towards a more operational type risk. So there's more of an acceptance of operational risk, not just in the hotels or as it's been emerging in the retail side, but also even on offices. I mean, we have serviced office providers taking most of the space. I'm sure anyone who owns offices at the moment has had serviced office operators suggesting slightly different rent repayment terms. So yeah.
And Neil, coming to you again, L&R invest in various different parts of the real estate market, and again, you're an early mover in the investment cycle. Last time around, do you see that competition for assets and the weight of capital there providing a real support to asset values as we head into 2021?
Yeah, I suppose it's difficult. It depends what you call it. Is it a support to asset values, or you just won't see the same diminution in value that you saw previously? As if you look through the various cycles, who the owners of hotels were, if you look early 2000s, the brands were selling. A lot of people got into hotels who didn't necessarily understand them, paid some pretty high prices. And then you had the next wave of owners coming in. As you've gone through the next cycle, you've had institutional investors now coming into hotels and paid a reasonably high price, used leasing structures because they didn't want to take the operational risk. And some of them will get hurt as they come out of this cycle because they expect a fixed or stabilized income. But throughout those cycles, I think what's been shown is underlying performance of hotels have continued to be robust and come back to previous levels, albeit sometimes the capital structure imposed on them meant that the values were diminished in the short term. But our feeling is that risk will move as you go through the cycles, and you've got to evaluate that. But when you look at all the other real estate classes as been discussed, the obsolescence within the hotel market, I think to Russell's point, certain markets are going to be more impacted than others, and that's where you've got to factor the risk in. But ultimately, hotels are in a fairly good position because they rent by the day. Yes, they are hit very quickly, but they also have the ability to bounce back. And the whole debate about working from home, retail, online, to go on holiday, well, unless you staycation, to go on holiday, you can't really outsource it and do it from home. People still need to move, people still need to travel. It will, the patterns of how people work, the big meeting businesses may change to some extent, but fundamentally, will they change as much as some of the retail sector, some of the office sector? I don't think so. I think hotels have that inherent benefit that people need to travel to have a holiday, to meet someone, and that will underpin our business. You know, all the other points about risk, wall of capital, interest rates, that is a relative position of risk. So as the overall yield requirements in the market are governed by capital, by interest rate environments, that will move. But fundamentally, hotels, I think, will remain attractive.
Yeah, I mean, I would also add that, you know, if you look at hotel performance over the last 20, 30 even years, if you look at it on a long-term basis, it historically tracks just above, certainly London, inflation. And so there's become a greater acceptance that hotels are an institutional class of asset. And if anything, once, you know, our heads are back through these clouds, I see it as an industry that, as Neil says, is much more resilient than perhaps other sectors. And you might end up seeing a growing level of institutional capital chasing hotels.
Yeah, I think all it will do is push towards an allocation of money towards operators who have experience, capital structures that are long-term, and if not location, asset classes. And if you look at, you know, not to drag Bettina into this discussion, but if you look at how Ariel has, you know, continued to lend within the hotel market, but if I look at the type of assets that I was first looking at with Bettina in 2004 to where they're lending today, you'll see a shift into centrally well-located assets, big boxes with good covenants of sponsors. So I think that will where the difference lies, is that people are really looking through the assets as to the operational sponsors and the locations. So that will where you negate some of the increasing risk within the market.
And Bettina, actually, just coming to you on that, yeah, you've got you know, Ariel, who are, you know, a big supporter of the sector, but also a lender into real estate more broadly. Have you seen an increasing trend of more, you know, institutional capital coming to you to look to borrow against hotel assets? Is that something you see continuing?
Yes, definitely. I think to Neil's point, the professionalism in third-party operators has been significantly increased, and the comfort that these operators provide to the investment community has also been very important in this whole process. Because to Neil's point again, you know, in 25 years ago, there was a Marriott that was managing, there was a Hyatt, there was Intercontinental Hotels. So those were people that were hoteliers, they were not investors. Now you have management companies that are also co-investing and that are, you know, aligned in the interest with the investors, and that also own significant ownership shares in some of the more important transactions. So therefore, there's a shared interest and also a shared belief in the industry. So I think this professionalism of this group of managers has really made the hotel investment more palatable to somebody that is looking for some sort of fixed return that normally only results from fixed lease agreements. And I think we at Ariel, we have always been supporting the investment model of a management agreement into a hotel rather than a lease agreement, which is quite uncommon, particularly given that we are, you know, we're from Germany, where the lease model structure has been the prevailing hotel operating model. But I think particularly this current crisis shows us that this lease agreement doesn't provide us the certainty that we have believed it does, and that rather than having a fixed lease that you believe you can rely on, you'd much rather have a reliable hotel operator that, you know, does it well when actually the problems come up.
So in a beautifully choreographed transition to the next part of the discussion, we wanted to change gears a little bit and follow that to just delve into that leasehold market, because I think you've mentioned a few things there in terms of alignment of interest in your discussion there, Bettina, and I think that is, one of the themes that certainly we see coming out of those discussions where there's restructuring activity involving leased assets. And I think certainly something that seems to have been driving, Lionel, your discussions with landlords at the current time with AGO. The lease assets have been really at the forefront of these restructuring negotiations. So, how do they have a future? Can you have operating leases? Do ground leases, still work? If they do, how do they need to change? What's the future of that lease model, Lionel?
I have to thank Bettina for mentioning the word alignment and the USP the Go Hotels has really been pushing, which is aligning landlords with the operator and with the brand, and that's what we've tried to create with the hybrid lease model. And I think that there will always be hotels that will be leased. We see with Premier Inn as to the strength that they've demonstrated throughout this crisis, and we also see the strength of their balance sheet. So I don't think that it's going to completely change, and the upheaval of a change in Germany to move away from such a robust leased environment. Wow, I mean, to turn that upside down on its head and move away from that structure to something else, it'll be a real shift change, and maybe COVID will be the catalyst for that. It's certainly been the catalyst here in the UK, and the common thread that we've heard from the landlords is, we want to take a little bit more risk. We're happy to take it. They understand it. And a lot of the landlords who we talk to have asset classes other than hotels. They have seen in retail, they can't carry on in the same way with these 100% leases. So they're looking at turnover lease options, which Hilton have been doing for a while. We know that model where the operator is responsible for the capex, and they're responsible for the management and pay you a turnover rent and a fixed base, etc., has worked for landlords to an extent. But again, it's not without its challenges on the capex side of it. And when you want the brands to invest in the capex, always seems to be a battle. So I think we've got to find the hybrid solution, and the market now certainly is ripe for it. However, I think there still will be the traditional real estate investor, the non-hotelier, who we were talking about earlier, the people who've bought into hotels that are perhaps real estate, or they're looking at something for their pension fund, and they're not the seasoned hotelier who understands the ups and downs of and cyclical nature of the operational business and won't want those risks. They may just find it an easy option to hold on for that 100% rent, but I think those rents will then drop significantly, and will have an underlying impact on the value of those assets. So the opportunity, I think, is to present landlords with alternative options today, give them the opportunity to benefit from the upside of taking that risk, which they haven't had the benefit of previously, and trying to bring them to the table to actually understand more about those assets. And we don't want to necessarily try and reinvent the wheel and teach these real estate investors what it is to be a hotelier, but we want to find the right asset management to support them, to deliver it, to work together with their operators, the brands, the banks, the valuers, and get to a point where the overall income and what's generated is hopefully above what the landlords were actually signing up for. And that's what I'm seeing with the people that we're talking to today.
So you see, of course, there is a future. It does need to adapt. I mean, Karen, you advise all sorts of clients when either looking at existing assets or new developments, and I'm sure they're asking you around, should I be looking at a lease structure, a management agreement? What do you think about the future of those different operating models? Is the lease model, is it going to survive?
Well, I agree with a lot of what Lionel was saying there. All I can say is that on the ground over the last 6 months, and we act for some pretty savvy commercial clients, nearly all of the new work that we've been doing is relating to management contracts. So we haven't actually negotiated a new lease. That's probably because of the profile of the clients we've been acting for. but there's been a lot of management contract activity, which has been very interesting in terms of the discussions we've also been having around how management contracts need to adapt post-COVID. Having said that, I do think there is a future for leases. There is a fear and a concern, obviously, around the ground rent lease structure. I think that's always been there, and that's come into sharp focus in the light of the issues caused by the pandemic. But I think there will always be an appetite for leases, but for sure we're seeing not new leases being granted, but parties talking about how they can mitigate the impact of the downturn by amending the terms of the lease, moving to turnover rents. And there is a real concern, I would say, over how the pure ground rent structure might play out, especially when you're looking at leases that were negotiated over the last few years with very long terms, index-linked rents with caps and collars. I was looking this morning at, looking back, it's almost a piece of history, at an interview I gave with to Catherine Doggerall for the hotel management publication back at the end of 2019, when I said, you need a fully performing hotel to support the rent with a ground lease structure. How true would that be? And of course, that comment was made then against the background of how does a tenant support an index-linked rent over a very long period of time. And I think there are a number of discussions going on at the moment between parties to those kind of leases as to how those will play out in the future. Having said that, I mean, people keep talking about alignment. Let's hope there's lots of dialogue going on, because after all, let's hope this is a once-in-a-lifetime event and that people will find a way through the current issues.
It's interesting that you mentioned about the leases and performing hotels, Karen, because that's why we've reduced our risk in terms of what we thought would be an offering to attract value to be maintained. And so we didn't feel we could stretch to 100% guarantees anymore. We operated a 50% guarantee of what they were achieving historically. And it's interesting that other landlords who've got hotels actually see that as a bit of a cushion. So I think landlords will look for a cushion where they've got a certain amount of rental guarantee perhaps, but they're willing now to take more of the upside, because going back to Neil's point earlier, there's a lot of belief out there that you can't take a virtual holiday. We can do this virtually, we can have these meetings online, etc. But no one's yet gone virtual skiing and really had the same experience, or virtual swimming in the sea. So we get to be able to deliver that experience to people. People will, perhaps there'll be more of a tendency towards leisure in the short term. But again, going back to Russell's model and what he was showing in his presentation earlier, the budget economy sector is probably more likely to bounce back, and there's a predominance of leases in that sector. So it'd be interesting to see whether people decide to change their minds. I think Karen's right. People will go more towards management agreements. It's clear if that's the trend that she's seeing, and we're seeing it, that people will, forego this supposed cushion of 100% rent guarantee when no one knows whose covenant's going to be strong tomorrow, and will they be there to actually pay the rent next month.
Yeah.
And Lina, you mentioned there around the expectations of recovery of different segments. Do you think that with that there are maybe different categories of hotel type that are perhaps better suited to lease agreements, and those that are better suited to either owner operation or management agreements?
I think that whoever's offering that lease has got to be really, really comfortable that as an asset manager or co-investor with that landlord, because I think skin in the game today is very much regarded as a true test of one's confidence in the ability to drive the future performance. So I think you've got to feel, if you're going to give a lease to anyone, that you're comfortable that that market can come back or will bounce back. And whilst we can't perhaps look at past results to predict the future as we once did, and we're going to have to use our foresight and be more focused on dynamic strategies for the future, not looking necessarily at the historic trading. But if we can feel that a hotel will perform, and my personal view is the budget sector's always come back more robustly than other sectors. It's come back faster, and it's less expense to run, so the profitability and maintain the profitability is a little bit more deliverable than a full-blown, full-service hotel that's got the spa, the leisure, the F&B, and particularly, with this pandemic, we know that those areas are being hit very, very hard in the main. We know that there's some bucking the trend, and we talked about this earlier, that London hotels may be seeing more people coming in for the F&B and less on the rooms. But I think in the main, moving forward, if I look at provincial UK, white van man traveling the country hasn't stopped because construction's continued. So if we look at that sector of the market, when people say, oh, the corporates aren't traveling, and how can you offer a lease agreement on a corporate hotel? I think that there are other segments that you've got to focus on that are traveling and where you can find the business. And the budget sector is I think, really ripe for that. I'd be a lot more concerned, Graham, to give leases on 4-star corporate conference hotel in a major city centre today. But I'd take a different view if it was on acquisition, potentially.
And Bettina, one of the people talk about what might be different in this crisis. I think one of the concerns that people have is, will this public health crisis translate into, if not permanent, then certainly more longer lasting impact on people's behaviours? So, if you're going into these kind of hotel lending situations and you have, potential customers coming in asking you to lend against particular hotels you're going to be exposed to for a number of years. Are there, how do you view that in terms of, there's concerns over business travel, there's concern over, kind of large events and when they will come back. Are you being quite subsector specific when you're appraising new borrowing requests on hotels?
We were actually asked by our regulators exactly the same questions, and we were asked to actually exclude certain hotel categories from our future lending. And then we discussed internally, and people put forward, why should we currently finance airport hotels? I think we should, completely exclude them. And we made a very strong argument and finally decided to not find any category that we would not be lending on right now, because it always depends on the circumstances. Yes, it's easily said a airport hotel is going to suffer more significantly, is going to take longer to recover because it's completely dependent on the flight availability and the pickup of those available flights. But in essence, it is all a question of the entire package. So it is the sponsor that we work with. Are they managing through this crisis well? And it is always a question of the perceived risk. Like Neil said it, where are we in the cycle? Where is this particular hotel type in the cycle? And how do we perceive this risk? At the moment, obviously, we perceive the risk in the hotel sector higher than we perceived it 2 years ago. That has something to do with the fact that at the moment, if we're looking at new financing, we're funding hotels that are closed. Partially. So we have always been a lender that said we don't want to finance market entry risk, and now all of a sudden we have a portfolio where 90% of the hotels that we finance are going to face market entry. So where do we perceive the risk? We perceive the risk higher today, therefore lower underwriting criteria. We look at lower LTVs, but this cannot be put into one category of hotels or into another. We firmly believe that every every hotel can have something going for it. With regards to outlook on the individual segments, I think you said it before, Leisure, or Neil has said it, we're not going to be able to outsource our unless we do staycation, which, you know, nobody wants to do in eternity. We are going to have to go or want to go away for holidays and stay in hotels. And demographics are highly speaking for that leisure travel is going to increase significantly in the next coming years. The other point regarding business travel, we are now sitting here and we're having really a conference panel that we would usually have in the Berlin conference. The thing is though, and we can do that and it's a good replacement, but will it be a permanent replacement? That I believe is the question. People say, oh, I can have all of my contacts, you know, and have Zoom calls and it works really well now. But this is because we have existing relationships that we can maintain. This is not because we found new relationships. And Robin Rossman from STR actually said something very interesting in his last panel, which really made me, was my positive thought of the day. It was like, you know what? Some people may decide they may not want to travel, but once other people start to travel again and they go and see these people's clients, you're going to be the first one on the road, making sure that you're not the last one going to see your client. So I think, you know, once, and that's to the point of the speed of the recovery, once we all feel comfortable to travel again, I think there's a certain need for people to show that they're still there and that they're in business. And once the first person does that, the next competitor will do it too. And that will add speed to the recovery in the business segment. I believe the conference segment is definitely going to take the longest, and we're obviously very careful and underwriting these hotels now. But we have also finance conference hotels in our portfolio that have had surprisingly positive performance. So I think it's very hard to categorize at this moment in time.
Yeah. Yeah. No, and Karen, look, you're a partner at an international law firm. You kind of see this firsthand in terms of how do big businesses change their behavior. Is there anything you see from kind of the activities of Bird and Bird that kind of help you form a view as to whether business travel is going to bounce back, or conferencing and events is still going to be a big expense for big businesses?
I think it will. I think most businesses are very, very wary at the moment of what they spend on travel and on conference business, in particular on attendance at conferences. And I think it's quite sad in many ways for big conference businesses that, look at the conference that we're hosting now on Zoom. This is a free-to-air conference, and I think a lot of conference businesses are really suffering as a result, ironically, of the kind of thing that we're doing at the moment, because these aren't going to go away, I don't think. I absolutely agree with Bettina that we're all going to have to move forwards because we are building on existing relationships. I think that's a spot on point to make. We're all being encouraged to go back into the office, and as Bettina was speaking, I was thinking, well, the sort of peer pressure for people to travel and meet their clients again is almost starting now in a smaller way, in terms of people getting back into their offices, meeting their colleagues, creating business. And we're already having meetings with some of our clients who are very keen to get back to some kind of form of business as usual. Just very briefly, having said that, I have spoken to a lot of people who would say, I really hope I don't have to start flying around the world again every week, because I realise there's a different life for me and my family now, and I really don't want to have to do that. So there's a lot of hope that we can perhaps have a happy medium.
Yeah, no, I think that's right, and it will take some time whilst this shakes out. And Safi, in terms of these changes and these shifts, has that changed your investing or lending strategy in terms of location target or hotel type?
I wouldn't say that it necessarily has. Clearly, you have to price each deal as it comes, and yes, probably if you've got a 5-star hotel right now, you're going to be a little bit more cautious about what your risk reward requirements are. But we're much more focused on perhaps the deal dynamics. And so actually often it's sort of the circumstances behind why a vendor is selling, say, a hotel asset that will determine it. And as long as we have a reasonable degree of confidence in our, underwrite and our returns, and at this current point in time, you can probably, do a little bit better than you could 6 months ago. Well, not 6 months ago now, God, I've lost track of time. It's more like 9 months ago. It hasn't stopped us from looking at any specific locations or sectors. I mean, as a business, we're London focused, but it hasn't stopped us looking at the more or less budget side of the market. It's just being a bit more circumspect about how you see it going forwards, ensuring that anything you invest in, you have enough capital to weather a storm. I guess our return expectations, if we were doing a hotel deal today versus 9 months ago, would be a bit higher, but then equally any vendor today selling a hotel is going to hopefully expect that as well. And we're a little bit earlier on in the hotel cycle than some of the other cycles, because there have been operators who have been caught a little bit unaware, and who perhaps didn't have the buffers that were required for what, to be fair, is a once in a century event. Well, we hope it's a once in a century event. I was telling you, I hope this isn't going to be a Pandora's box moment, and every time there's some sort of cough, we'll all be locked back down. I don't think that will be the case. I think we'll realise that is not, and it really will be more like a once in a century, once in a not even once in a lifetime event.
But let's hope so. And Charles, you when you come to sell a hotel, then you'll spend time with the selling client looking at that business plan, and I'm sure you'll be poring over the different kind of customer categories. Are you, when assessing that, are you really appraising a real shift in mix between, if you like, the large corporate accounts, a shift away from meetings to more leisure travel? How are you judging mix when you're assessing those business plans that you're putting out to the market when you're selling?
Well, I think it really is. It's case by case. You really do need to dig deep into the drivers of demand for a particular hotel and the segments that it's historically traded in. But I think, going back to points that others have made, I certainly believe in, and I think the market does generally, in the relatively near-term recovery in short-haul business travel. I was in Germany last week for a week of meetings, and it's good to see that Germany feels a lot more back to the office and back to some more normality than the UK does right now. But these were kind of old-fashioned face-to-face meetings, and it's very clear that they were so much more worthwhile than equivalent meetings over Zoom or Teams. So I don't think anyone doubts that the business sector will recover. I think there will be sort of longer term damage, if you like, to long haul business travel, and the MICE market will take longer to recover. But hoteliers are creative, and where there's a hole left by certain types of demand, they're good at filling it with others. And I think we will see increasingly shifts towards promotions for leisure, and that's already evident in regional city hotels in the UK, which are seeing more leisure business. London, I think, will increasingly shift more towards leisure focus, so will Paris. And that's, I think that's the way people are looking at it.
Yeah, it's been actually very interesting seeing the performance in our hotels, because whereas before midweek would be so much more busy, our occupancy has completely flipped, and it's the weekends supporting the weekdays. By an occupancy multiple of 2, sometimes 3 times.
Wow. And Charles, there was a point raised by Karen earlier around ground rents. and potentially their attractiveness, their robustness and ability to trade through. If you're appraising hotels at the moment, does the presence of a ground rent, given the current crisis, is that providing a kind of a negative pressure on the valuation of those hotels?
Well, it creates increased leverage within the structure. So by definition, it will mean a disproportionate reduction in value. So they were very much flavor of the month a while back. They're not today. But it's interesting. I mean, I think that demand for long-dated fixed income is possibly stronger than ever right now, with government bonds going negative in a number of countries in Europe. And I think we could, both on ground lease structures and operating lease structures, we could see yield compression moving forward. So this is not the end of the lease, whether it's a ground lease or an operating lease. We're going to see the lease is here to stay. I think investors will increasingly be prepared to take operating risk, but the bulk of the rent still needs to be fixed and certain. They're much more focused on rent coverage, but I think we're still going to see a lot of lease activity, and if anything, further yield compression.
Certainly we're being asked all the time when looking at leases, and something we're advising clients on is, when you're looking at new leases at the moment, make sure you look very carefully at your break rights. Are you tied in for 20 years, 25 years? So many clients are saying to us, why can't I get out of this lease because of force majeure, because of this pandemic? Why don't I have an automatic right to exit? And they're becoming a lot more cautious of their exit rights for leases. And just another word, I guess, on ground leases, which is that when these were all being done originally, the investors were saying, what have we got to lose? If the tenants don't pay the rent, if they don't perform, we have all these wonderful protections. We can forfeit the lease. But in a market like this, that isn't necessarily your answer, because who else is going to take the lease? Who else is going to step into the shoes if you do forfeit the lease? And undoubtedly, you will be having to negotiate more favourable terms to that tenant probably than you have with your current tenant. So our clients have certainly been taking the view that rather than look at forfeiting leases when they legally can, they'll be far better off renegotiating some of those terms to try and keep the tenant that they've got, often which has a pretty respectable covenant, rather than going fishing for a new operator.
Yeah.
So I suppose, sorry Graham, this is just more the sophistication of investors and understanding the underlying, regardless of what we're talking about. And if I look around at the faces on the screen without causing too much embarrassment, a number of us have known each other for a number of years, and I think this panel shows it becomes a sophistication of the investors looking at the underlying sponsor quality. And at LNR, we're actually agnostic on structure. We can talk to the Bettinas of this world for management contracts and franchises. We can talk to other lenders on ground leases, but it's the underlying asset needs to be viable and priced in the correct way. And then the lease, the management agreement, the franchise, the unbranded nature are just capital structures and ways to market. But to Karen's point, in not being too crude, if you screw up the underlying business plan, it doesn't matter what you do, you're still screwed basically. So, understand the underlying business, put the correct capital structure in for that particular asset. They all have a place in the market. But too many times people thought 1 and 1 equaled 3 and put an incorrect capital structure on an asset. And, just thinking about it while everyone else was speaking, has our risk profile changed? No, actually the market's just coming back in line with where we always sat. Is another way to look at it. So the underlying assets don't change, they just go through cycles, and investors need to realize that and price that incorrectly. And to Karen's point, there's a growing sophistication of lessor investors as to what they need to get that income stream and what the underlying structure needs to look like. But the actual viability of the asset hasn't changed. It's just going through an unfortunate cycle, but one that we all knew from your point at the beginning, Graham. We knew something was going to happen. I don't think anyone would be bold enough to say they predicted this, but something always happens. And the question is if you forget about that, then you're in trouble.
Yeah, no, absolutely. Absolutely. That's quite right. I mean, we are coming up towards the end of the panel, but I wanted to kind of wrap up just with a question from a few on the panel, which I think will be on everybody's lips around, when does this crisis become an opportunity? You know, as Russell raised in his presentation, you know, the risk appetite of banks is a really important part of this. So Bettina, coming to you first, you know, given where we are now, when does this crisis become an opportunity? When do you start looking to expand the book again in this particular sector?
You've asked two questions. You've said, when does it become an opportunity? I think it already is an opportunity, because as I said, it could very well be that the recovery will go a bit quicker than we may all expect. When I compare, when I compare how many people call me at the moment to ask if we have opportunities in our book, when compared with the financial crisis where this didn't happen for a good year or so, I believe people are perceiving opportunity already. The question is, when will I look to expand or when will we look to expand the Area loan book? That is a very good question, because we have increased our loan book significantly over the past 3 years. We had reached stabilization in 2019, our target. We will maintain size. I think that's important to say, because we're also doing new financings. Will we look to increase it at the moment? Selectively, yes. We are continuing to do business, but we're not looking for a massive increase like we looked at in the past 3-4 years, because we have exactly reached our targets and we're comfortable in that sizing limit. But that doesn't mean that, you know, other other banks are decreasing their exposure. We're fine where we are.
Thanks, Bettina. Lionel, Topland were an early mover in the previous cycle. What's your perspective on this?
I think that that wall of money is ripe and ready, and their people are just they're waiting to get back into the sector, and they're waiting for the opportunities to present themselves to acquire. And if you're a seasoned hotelier, you're going to look at this market and think, you know, the people who are in real estate and bought a hotel for whatever reason they bought a hotel and thought they'd have some fun with it, they're going to be suffering, and there'll be an opportunity to buy properties that you perhaps couldn't have previously afforded, that are going to come to market today. So I think that wall of cash is there and waiting to pounce. And I think that the opportunities are already here. What we're doing with the Go is an opportunity, I guess. I don't want to see the demise of any other business, but I think that the circumstances of the pandemic have created an opportunity to reevaluate as hoteliers. And I think you said this earlier, Graham, that we're quite creative people. We find opportunities. We'll fill a gap where we see the opportunity to fill a gap, and try to expand our businesses despite whatever circumstances we face around us. So I think the opportunity is here and now. It's just going to grow over the next 6 to 12 months.
Great, thanks, Lionel. So I've had the note that we are coming up towards time. Chris, do we have any time just to wrap up with a final question, or are we running up against our time limit?
We've got 6 to 7 minutes left, so please ask a question and we'll do the wrap up.
Great stuff. So yeah, just a final person I just wanted to come to again on that crisis becoming an opportunity. Safi, just wanted to come to you on this, because what I think is a really interesting angle on this particular pandemic is, you know, what was undoubtedly one of the most prime locations in the world in London has become one of the most profoundly impacted by this particular crisis. And given your focus on London, it'd be great to get your view as to, you know, when you see the opportunity arising again.
I mean, I certainly second Lionel. The opportunity's already arisen. The hotel market and other operating segments are, you know, always going to be the first to be hit. I mean, the sudden and unexpected capital requirements that hotels were faced with trying to fund in March and April were unprecedented. We'd never had a period of time where, you know, there was zero income coming in, but huge outgoings still coming out. And so if I look back at what we've been working on during the crisis, hotels and to an extent retail have been the opportunities that have come up first, and they've been, to Lionel's point, they've been hotels that perhaps we would not have looked at a year ago because they were too expensive. They might have been stabilized, or they were too prime to hit our return requirements. And so I think the opportunity is already a crisis. It will continue to grow. I think the next wave will be probably driven by lenders getting impatient as their interest fails to be paid, or as covenant tests start to come up, or if they decide to stop waiving covenants. The first wave was due to just immediate capital requirements. Yeah, and as I said, we did a London hotel deal during the crisis, and we did. It was tricky because it was something that we started before, and we had to change tack on the senior lender. We were the mezz, but we worked through it, and the crisis actually made it a slightly better deal for us. And so it's already here, and it'll be one that we'll continue to work on.
Great, thanks, Safi. Well, that's an encouraging point on which to end. Just want to say thank you to all the panelists for attending today and sharing your views. I thought that was excellent. Thank you very much.
Thank you, Graham. That was excellent. Thank you. Look, thank you to everyone who spoke today. It's been the most fascinating session to listen to, and actually very reassuring, I have to say. I found it really quite inspiring. I think there's a book to be written on the journeys you've all gone through, I have to say, over the last 6 months. I'd be interested to see how your thinking has changed and evolved during those 6-month period. So fascinating. Before we finish, I think we've got one final poll question to ask. Lauren, can I just bring you in?
Yes, absolutely. We actually have 2. Now that we've heard the experts, we'd really be grateful to have your opinion on these. So if I could please ask, by how much do you consider the value of your hotel will have fallen in 2020 when you compare this with the value at the end of 2019? And your options are less than 10%, 10 to 20%, 20 to 30, 30, or more than 30, or I'm really hoping someone's going to say that it's gone up, and someone has, which is why 2 people have. That's wonderful. So it looks like 10 to 20% is the majority here. Thank you for that. And then the final polling question is, when appraising a new investment, what do you think will have happened to hotel yields? Do you think they would have slightly reduced, significantly reduced, stayed the same, slightly increased, or again, hopefully significantly increased? There is some positivity there. Slightly reduced, but slightly increased also does look good. So thank you so much for sharing your thoughts. Also, I just wanted to say that...
Sorry, Lauren, it's Russell. I just wanted to jump in on that.
Yeah.
Actually, going down means that people feel quite positive. So
other way around. There we go. Thank you, Russell. Well, positive is what we'll take from all of this. Absolutely. I just wanted to also say that the Q&A is, thank you very much for sharing your questions on the Q&A. We will definitely answer those after the session, so please rest assured. Thank you, Chris.
Thanks, Lauren. That was great. And again, thank you to everyone. I think that was a fascinating session, which actually I found reassuring and positive. Russell's session, which talked about the 6-year cycle of recovery from his history, and how actually we seem to be seeing the same now, with the most likely forecast of 10 to 20% fall in valuations, but recovery by 2023, which seems to be better than it was in the global financial crash. And the overall picture, I thought there's some great stuff in Russell's presentation. So anyone who would like a copy of that presentation, Lauren does have it, and we will email it out to anyone who would like that. Graham's panel, a whole range of great points coming through on that one. I thought it was really interesting how positive the whole panel were, and how you're actually beginning to see real opportunities emerge again. I think that's the thing. I think, particularly as there's been such negative news cycling around over the last couple of weeks, great to hear the positive impacts coming through all across the market. So thank you. Thank you to all. I'm conscious we're out of time. Thank you for joining us today. I hope you have a great rest of the day. Our thanks to all the speakers. We will come back to answer all the Q&A, and we look forward to seeing you again soon. Thank you very much indeed for today.
Thank you.